Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching.
For this morning, what we're going to do is that we're going to dissect some trade ideas, and we're going to, the only criteria we're going to have with these trade ideas this morning is that we do not want to use more than $400 in buying power. That's the only criteria. Normally, when you're trading the Dorian Way, we have a lot of criteria that you need to meet to be able to do a standard type of Dorian Way trade. But this morning, we're going to optimize a trade based on only the buying power, based on not using more than $400 in buying power, and then we'll see which trade we like the best. I'm kind of leaning towards a trade that I was looking at, but we will see what you guys think. So let's jump into that now. Looking at this ES here, you have obviously the markets are down a little bit. They kind of went down after the market opened. They were up for the most part throughout the evening. And so looking at this R2Y, this is a kind of trade I wanted to put on. You can see that the R2Y is still below its 200-day moving average, which is this gold line here, and it's just above the 50-day moving average, but that 50-day moving average is below the 200-day moving average. Once again, it's this gold line. When I see this in my world, this is bullish. I would be more bullish on R2Y than bearish, or I would be neutral. So looking at this right now, I'm going to do something that's neutral, maybe leaning a little bullish. So let's go over here and let's bring up the R2Y and let's look at 56 days here. And I'm going to do something neutral. So I'm going to start with the call side here, and I'm going to go to, let's say, a 7 delta on the call side, and let's look at a 30-point wide. So we don't want to use more than $400 in buying power, as we indicated, and buying power is located down here on the TastyWorks platform. So you can see that this is basically no buying power for this call spread on this position. And this is span margin options on futures, so it's going to be based on what you have on. So if you don't have anything on in the R2Y, or your portfolio is not leaning long or something such as that, then this might require $300 or even $400 for you to do this trade at this point. So if I go down to the put side here, so I'm going to lean neutral. I said a little bit bullish. So if I sell this, let's just say I sell this 10 delta, and that was 30 points wide on the call side. Let's just say I went 40 points wide on this put side. So if we did this trade, you can see that this is giving us $205 of profit before fees and commissions, but it's going over that one requirement we have this time. We only have one requirement, and that's not to be more than $400. So this is more than $400. So when you optimize in a trade based on the criteria or just one factor, the way we're doing right now, then you want to adjust the trade. And one of the ways you can adjust the trade is by deltas or the width of the spread. So we had a 40-point wide here. So if we move this to a 30-point wide, that should reduce the buying power and still keep this as a pretty attractive trade at 173 before fees and commissions, and the buying power effect only 311. So this is pretty nice, right? So we have a 10 delta on the put side, and I believe we had a 7 delta on the call side. So you add those up, that's 17. You take that from you subtract that from the from 100. So we have an 83% chance of winning on this trade, which is not bad at all. So if you take that 17, you subtract it from 100, you're going to get the 83. So that's why I'm getting that 83% there. So that's not bad at all on this trade. So let's look at a couple more and see if we want to do this one. So this one meets the criteria of the buying power. It's actually giving us a decent amount return on the capital. It's 173. And then if we go over here to the NQ, and you can see that I got this geared up already, kind of matching it towards the 56 days. So I got the 56 days on this. On the call side, I was thinking about something neutral on the NASDAQ as well. It was up a decent amount yesterday. It's down a decent amount this today. I think we're going to stay in a range. We're not going to go up a significant amount from this point. Well, I'm hoping we don't. I don't want us to go back to all-time highs too fast. And I don't believe we're going back to the lows that we've seen about 3 weeks ago. So looking at this trade here, on the call side, we're at the 6 delta. We're doing a 50-point wide. And then on the put side, we're at the 9 delta, and we're doing a 50-point wide as well here. So they're both 50 points wide. Our max loss, as you can see, is only 880. The buying power is under 300, 370, 275, and the max profit for fees and commissions is 120. So this is more attractive buying power wise, as you guys can see, but it's not as more attractive as the profit on that RTY. We were getting, I think, 173 before fees and commissions. So that was attractive, right? But both of these trades are definitely attractive to me. You decide which one, and we'll kind of do a quick little poll to see what you think. So RTY is the first trade. NQ is the second trade, and then our third trade and final trade that we're going to look at is what we call the VIX. Okay, now the VIX is the volatility index. It's nicknamed the fear index because when the market is going down, almost 100% of the time, the VIX is going up. The VIX is the fear index. The VIX is the most popular volatility index. It's associated or attached to the S&P 500, the broad market. As you can see right now, the VIX is up almost 8% as the market is only down, or the S&P is only down 0.5%. So almost 100% of the time, when the VIX is going up, the market is going down, and vice versa. When the market is going up, the VIX is going down. So when you are playing a VIX trade, if you sell a call spread, the way we have it set up here, that is actually meaning bullish. Most of the time when you sell a call spread on something, it's bearish, but this is the inverse. So in this case, if you're selling a call spread, it's a bullish position. Okay? It's a bullish position. And because it's if the S&P 500 goes up, then this VIX is going to go down, and then you'll win on this call spread. Okay, you'll win on this call spread. So this is an interesting type of trade to me. It's one of my favorite trades, especially if you are trading with portfolio margin. So I wanted to set this up in a way that someone with regular T margin can trade it as well. So the delta is quite high, as you can see here. This is a 37 delta, and the strike price is 27. When trading the VIX, we don't get out based on the normal Dorian Way criteria of deltas, the green, yellow, and red zone. We get out if the strike is touched, if your short strike is touched. That is your exit point if it's touched. So in this case, we can do this 37 delta, which is out of the norm that we would normally trade, and we will hold this until this is touched. So it's meeting our criteria. We're only receiving $60 based on the trade though, and the buying power is 340. But that 60% is based on 21 days, that $60 is based on 21 days, and 60 divided by 340 is 17.6%. So this is a really good return on your capital. It's not that standard 100 that we like at least, but this is a good trade in my opinion. A little bit more risky than that RTY, a little bit more risky than that NQ trade that we just did, but this is attractive. I haven't demonstrated a trade like this in a while to members, because most members don't have portfolio margin. And if you have portfolio margin, you can actually get further away and make this a very high probability trade. All right. So with that said, this is the trade I actually like, that I want to do. I like the other trade, especially that NQ or that RTY, that first one we did because of the 173. I like that the most technically, but we haven't did a trade like this in a while. So I want to do this VIX trade on this live pop-up session here. So I'm just betting that we're not going back to 27. Once again, you don't get out of this until it's touched. right? So this VIX would have to go up another 7 points. So what that would mean is that you take $7 divided by 20, and it would have to go up another 35% to be able to touch that strike. Can it do that? Absolutely, right? But I'm going to bet that it doesn't. And if it does touch it, our max loss is going to be significant, or our loss is going to be significantly lower than this max loss. Okay, it's going to be significantly lower than the max loss because it's still going to be some time, and we're getting out once the strike is breached. Okay, so that's put that in, and let's see if we can get filled here. And we're only going to get $52 after fees and commissions, and after what is that? This is 2 strikes, and then we're going to do it anyway, and we're going to send this, and we're going to see how if we get filled. And if we get filled, then great. I want to get filled on this call, and we're going to let that play for just a second. I might put in that RTY trade and see which one we get filled in first, but I really want to get filled on this one, but I don't want to lower the price. I don't want to lower it again based on how much we're already getting. If we take the price any lower, we're going to get less than $50 after fees and commissions, and I don't want that. I hardly ever, if ever, do a trade that don't give me at least $50. All right, so let's bring up this R2Y really quickly. I think I like that one, the second most, or actually the most, like I indicated. So let's see what we can get filled here. And 173, we're going to put that at 350, and let's see, we're going to send that, and we're going to see which one gets filled first. Which one gets filled first is going to be the one that we execute. So that you can see that VIX is not getting filled yet at the 30. I'm going to bring this down to the 145. I'm going to be a little disappointed if I don't get filled in the VIX first, but I'm going to bring this down on the call here and send that. And that is at the 143. So we're going to give it a second, similar to what's going on right here, right? So I'm going to change this price here. As you can see, this is a credit that we're trying to get. Our price is 345. The mid is saying 345, 360, 343. It's jumping all around. But if I move this mid down, perhaps, let's just say, let's say I move it down to 340 and we send it.
That's not going to get it at that either. I've been sitting at 340 and it's not.
Okay, you've been sitting at 340, so it's not going to give it. But I bet we're going to get filled at 325 or 3, definitely 100% at 325, maybe 335. So let's just try it, right? So I'm going to put it in like that. We're going to hit send, and there we go. So we got filled at 335. We're going to take off the VIX one, unfortunately, but I wanted to put on a trade while we're on the call here. So we're going to delete that one. And this is the one where we got filled at, and I think it's a pretty good trade. It's 56 days out. It's pretty far out, but that's been working well for us. And if we go here and just look at how far that put side is away from at the money, that's the 1770. It's a 10 delta. It's only a 30-point wide spread. And if we do the math, we got the 1770 minus what is currently trading at, which is this 2065, divided by the 2065, and we get 14.2% away. So I like that trade. It's pretty nice. And